Yo, what's up? What is a 10-year bond? A 10-year bond is a debt instrument where an investor loans money to an issuer, usually a government or corporation, for 10 years in exchange for periodic interest payments and the return on the principal at maturity. Common issuers: U.S. Treasury T-note, most recognized and used as a global benchmark. Corporations issue 10-year bonds for financing, typically with higher risks and returns. Municipalities may issue 10-year bonds to fund infrastructure or local projects. Key characteristics: maturity, 10 years from the issuance date. Face value, usually $1,000 per bond, but can vary. Coupon rate, fixed interest rate paid semi-annually. Yield, the effective return which fluctuates based on market price and interest. Price, can trade above premium or below discount face value. Yield versus price relationship. Bond yields move inversely to prices. Example, if the interest rates rise, existing bond prices fall, pushing up their yield to match new bonds. Role in the financial system. Number 1, risk-free benchmark. The 10-year U.S. Treasury yield is considered the risk-free rate in many financial models. Example, CAPM, used to evaluate other investment returns. Number 2, economic barometer. Rising yields often signal higher expected inflation, stronger economic growth, tightening monetary policy. Example, rate hikes. Falling yields often suggest recession fears, lower inflation expectations, market uncertainty. Examples, flight to safety. Number 3, Federal Reserve sensitivity. Closely watched by the Federal Reserve. Fed policy, like changing the federal funds rate or buying bonds via QE, impacts bond yields. Impact on other markets. Stock market may depress stock prices, especially growth stocks. Mortgage rates rise as mortgage rates are linked to long-term treasury yields. Corporate bonds. Yields increase, making borrowing more expensive. Foreign exchange. A higher yield may strengthen the U.S. dollar as foreign capital flows in. Real-world example. If the 10-year Treasury yield goes from 2% to 4%, the price of existing 10-year bonds drop. New borrowers like corporation or home buyers face higher interest rates. Investors might shift from stocks to bonds, affecting equity valuations.